So 19,635 on the index. We are down about 37, 38 odd points or so, which is, I think, absolutely fine given the scale of the move that we've seen recently and, of course, in particular yesterday. Our market master of the day is with us. Hiren Ved is Director and CIO at Alchemy Capital Management. He's with us here in our studios. Hiren, great to have you with us here.
Thank you.
Thank you very much for your time. Thanks for dropping by.
Thank you.
How are things looking, Hiren, as we've almost wrapped up the earnings season? We've got a bit of a push from global markets as well, with more and more conviction that maybe this big global 500 basis point global hiking cycle is behind now.
Yes.
Market seems to be getting behind that particular idea. What's your sense?
Yeah, so I think two highlights, right? From a macro perspective, it does look right now that we are past strong yields, right? I mean, unless something very untoward happens, even oil prices have corrected, which means that incremental inflation going forward should not be such a big worry. Back home domestic, I think Q2 earnings season was fantastic, right? So you've seen roughly about a 1% upgrade on Nifty earnings. So Nifty earnings are stable, and the broader markets have delivered almost a 40% plus PAT growth. So which means that all the margin-led compression, degrowth that we saw in 2022, the first 3 quarters of the financial year, now between this calendar year, Jan, and then the first 2 quarters of this financial year, you've pretty much recouped all of that, right? So from here onwards, I think it's really about which companies and sectors can deliver growth. So, we've kind of recouped what we lost. Top line growth was not great, but margin growth was very, very spectacular. It looks like, from what we hear, is that the festive season has gone pretty well. So third quarter earnings should also be reasonably decent, right? And I think we are not too expensive from a Nifty perspective, because if you're talking about 1150 earnings in FY25, you're at about 17 and a half times, which is not like exorbitant. You may see a little bit more consolidation, but I think we are certainly building a base for new highs, maybe at the end of the year or early next year. Very difficult to call in the short run. But the simple view is that if we have endured everything, the fastest rate hiking cycle, we've endured 2 wars, and despite that, if the markets are where they are, that tells you the inherent strength of the market, right?
Absolutely.
Well, Hiren, great to see you in the studio. Season's greetings to you. Hope you had a great festive season.
Thank you.
So since the going seems to be good, and you're saying there's inherent strength, the question is what to do from here on. I think that's what everyone's grappling with. You get a 1,000-point dip, everyone knows what to do. The thing is close to 20,000 levels. Now, how do you go about allocating fresh money? What's your advice?
So I think, look, there is no reason to be bearish on the markets, right? But we have to be mindful of the fact that sectors that have been doing well, a lot of the returns, we are already discounting FY24, in many cases FY25, right? So from here on, you need to really have a 3-year view if you want to invest in small and mid caps. Because obviously we've had a phenomenal rally from the bottom. There's obviously strong visibility, strong growth, but all of that is also reflected in the valuations. On the large cap side, obviously, markets haven't done that well. And just from a short to medium term perspective, I think that the risk reward is far more favorable on the large cap side, right? So, and I think still there are opportunities. Autos may continue to do well. The big banks haven't done much for a long period of time. So I think in general, from here onwards, if you're a small mid-cap investor, you need to have a 3-year view. But if you want a 1-year view, I think the large caps is where the value is.
Hi, Hiren. Good to have you in the studio yet again. Hiren, what do you make of some of these large financial institutions? Case in point today, we have some negative news on Bajaj Finserv. Big value creator, mind you. It's recently underperformed. You have some negative news that comes in there. How do you position yourself out there? Banks haven't really performed, though earnings have looked quite good.
Yeah.
But on some of these NBFCs, some of these negative news actually provide entry opportunity. How do you place yourself there?
Yeah, so I think if you look at the situation between banks and NBFCs, right? I mean, what banks are likely to see is a continuous contraction in NIMs,
Yes.
right? And while year-on-year growth is pretty decent, quarter-on-quarter growth, is very hard to come by on that base. And we've seen the best of everything, the best of credit costs, the best of NIMs, the best of credit growth. So I think that's one reason why, despite good numbers, the big banks aren't moving, apart from technical reasons. There, I think, I agree with you that NBFCs incrementally may do much better. And if there are news flow like we have today in Bajaj Finance, that is probably a great opportunity to get in, because as interest rates start to fall next year,
Yes.
you will see their NIMs actually expanding as opposed to contracting, right? So it's a good place to be in within financials. And I think the banks will have to navigate, and we will have to see how far the NIM compression goes. Having said that, I think, they're reasonable. So, I mean, if you have to allocate a lot of money, I don't think you have a choice but to buy the big banks. But if that's not a problem of yours, you won't lose out either if you don't own them.
Hiren, refresh our memories. What do you like in terms of specific stocks, and what are you getting behind in that sense?
So, Prashant, I think that as I've said before, I do believe that we need to go back to the cycle of 2003 to 2008-9, the kind of sectors that were leading at that time, real estate, manufacturing, capital goods, power, hotels. I mean, all of these sectors, to my mind, will continue to do well and lead the rally. And then to that you add EMS and defense, which are the new leaders in this bull market, right? So you need to have enough allocation to them. But as I mentioned recently, that they're not cheap, right? Because everybody knows that that's where the long-term visibility and momentum in earnings is. And they're also priced accordingly. So you need to have a really long-term view to bet there. I think the area which might be very interesting and which has not done well in the recent past is your consumption at the lower end, right? That's been hurting very badly. We've seen that discretionary small ticket consumption has not done that well. I don't think that will continue to be the case forever. And there is no euphoria. Nobody wants to buy that because there's no earnings momentum. But if you have a good business, good management team, eventually demand will bounce back, if not today, next year, right? So there, I think the risk reward is far more favorable.
Give us a few ideas there.
I mean, without going into names, right? I mean, let's say QSRs, the liquor companies, we've been very bullish on them. Even selectively, maybe FMCG at some point in time, because that's where the rural growth has hurt people, and those stocks haven't done that well. Obviously, valuations are a concern there.
Yeah.
But I think that whole consumption at the bottom end, low ticket, is where stocks haven't done that great. And I think that's where you could be one hunting ground. Secondly, if you're a real long-term investor, I think agrochemicals haven't done that great either, right? Because uneven monsoons, inventory issues and so on and so forth. But if you're a long-term investor and you want to buy, there are some great companies there as well. One could go look hunting there as well, right? So these are areas which nobody talks about right now, but this is where I think incremental risk reward is so favorable if you have a slightly longer term view.
Okay, so basically look for the underloved areas of the market, perhaps.
Yes.
That's one way of looking at it. But I'm going back to the loved areas for just a second, which is capital goods and manufacturing in this entire sort of universe, because you've seen the cycles. Talk us through the differences between the 2005 to 7 cycle and now. We were just discussing, for instance, a stock like Siemens yesterday.
Yeah.
And the sector analyst reminded us that it's trading at 55 times forward earnings. Now, so how does one comprehend these new valuation levels that are existing today? And how does one guard against excesses, which are bound to happen when you're in this bull market?
Look, I think the challenge in something like capital goods, looking at PE, is that they will always optically look very high, right? Because you have to believe that this cycle will continue for much longer. higher for longer, what we use for interest rates, is what we need to believe.
For valuation multiples.
So I think the valuation multiples will keep correcting as earnings growth keep happening. Let's take a classic example of ABB, right? Now, obviously, it's not a cheap stock, but it continues to surprise quarter after quarter. Last 2 quarters, it has surprised, right? So as long as companies are able to rack up their order books and surprise on margins, which is typically what happens in the early stages of a good capital goods cycle, right? The stocks will continue to perform. And as I said, in all of these so-called loved sectors, as you call it, the love needs to be longer term. It can't be short-term love, right?
Not a fling like.
You can't.
Okay, so higher for longer. I'm going to start using that phrase in a very different light now. So thank you for teaching us that, Hiren. Pleasure having you in the studios today. Thank you so much.
Thank you. Thank you so much. Pleasure.
Okay, let's just take one quick look on the